So I've been getting quite into learning about DEXEs recently, and I thought I'd take you through the Maladex white paper. It's a white paper I've been meaning to read for a while, and I decided to not put it off any longer. And I'll take you through it. It's going to be a little bit technical, I suppose, at times, but I'm going to be pausing to explain to you key concepts. So let's get going. So in this first part of the paper, Maladex are explaining key terms. Market takers are people like you and I that interact with the DEX in order to exchange assets, and market makers are potentially also people like you and I, or it could be people like liquid finance, people that provide the liquidity into a DEX so that you can make those exchanges. Liquidity is a very important term in any sort of exchange, centralized or decentralized. It basically means the amount of that asset floating around for people to trade. The more liquidity there is in a system, the easier it is to trade, whereas the fewer coins or assets exist in that system, the harder it's going to be to trade that asset, and also there'll be a higher volatility on the price of that asset. So good liquidity is important in a market. This paragraph here is quite important. The formula for liquidity provision in traditional finance has geometric distribution, very well defined higher moments, and is provided in very tight ranges. Contrarily, in DeFi, most liquidity formulas, such as CFMM, which we'll look at later, believe that it is just as likely to buy asset X for $20 as it is for 1,000, 1 million, or 0.0001. The inefficiency of the formulas utilized in DeFi are the source of impermanent loss, capital inefficiency, inefficient and slow price discovery, and loss to both market makers and market takers. So really, in this one paragraph, Maladex have summed up what it is they're trying to solve, and it'll make more sense as I go along. And this theme of efficient use of capital runs throughout the paper. It's the kind of the main argument that Maladex are making, is that the current crypto market doesn't behave as an efficient market should. So here's a definition of how an efficient market would operate, and this is a classical definition of a efficient market by economists there. But the crypto market is a weak form of this efficient market because of the small size when compared to the size of traditional finance markets. Pricing models are flawed and lead to slower convergence on the market price. Historical reasons where early investors called whales had a disproportional amount of wealth, and so on and so on. All the things that anybody who's been in crypto for a long time would be quite familiar with. So there's all these inefficiencies in the DeFi space currently, and Maladex are focused on trying to get rid of those and have an efficient DeFi platform. Now, in a centralized market, you'd have a market maker that helps provide that liquidity and also carries out the transaction for you. And that market maker is usually a centralized body, such as an exchange. With decentralized finance, there is no middleman, no middle entity. So as it says here, AMM, the automated market maker, is the underlying protocol powering all decentralized exchanges. AMM is the autonomous market-making mechanism which eliminates the need for centralized exchanges or large single parties taking the role of liquidity provider and creating all related infrastructure themselves. AMM pulls the liquidity from the network and replaces centralized market makers with code. The unique property of a DEX is that nobody owns it per se. The protocol specifies how providing liquidity and trading work. The code will be open sourced. So that essentially is the key thing of what a DEX is there. A vast majority of DEXs rely on the CFMM model, which we're going to cover in just a second, to define the liquidity curve. Those are formulas that specify how transactions are performed and how the price changes in response to transactions taking place. So when you're making a trade on a decentralized exchange, the code needs to be able to figure out how much token B you're going to get for giving it token A. And that's what we're just about to cover. So here Maladex are explaining how a automated market maker works, in particular the function that it uses. I'm going to explain it a little bit better than this paper does in just a second, but at a high level the concept is if you've got two types of assets, so let's say Ethereum and OMG coin, then the number of coins that you have in Ethereum, let's say that's the X, times the number of coins you have in OMG, the other asset, multiply those two together, you're going to get some number, and your liquidity pool must always result in that exact same number. So if you took away some coins on this side, you have to add in more coins on that side so that this holds true, that you always get back to this exact same number when you multiply them. And vice versa, if you take out some coins here, then you're going to have to add in coins here so that this always holds true. And that's essentially what this mathematical formula is doing. This triangle in mathematics means change. So this is coin 1 minus the change. In other words, what's a new value for this coin after the transaction, and what's a new value for this coin after the transaction, bearing minor transaction fees. But let me explain this all a little bit better than what you see here, because I know formulas can be a little bit hard to follow. So let's go over to this great example from, I think it was a Uniswap paper. So let's say you have a pool that has 10 Ethereum tokens and 500 OMG tokens. You multiply them out, and this is what they call the invariant, that little constant that we talked about. So 5,000 is the key number. A OMG buyer, somebody who wants OMG, they add 1 Ethereum to this side, and then what happens is a 25% fee is taken out. So of that 1 Ethereum, 25% of that Ethereum is taken out, but the remaining Ethereum gets added to here. So you end up with 10.9975. So there's that 10 original Ethereum plus the 1 that was being added, but minus the fee that's being charged. So this is a new Ethereum that you've ended up with. You then need to calculate, well, what should this number be in order for this 10.99 times some number here, we don't know yet what this number is, should equal 5,000. So, basic mathematics, A times B has to equal 5,000. In this case, because we've added to A is now 10.997. So A times B must equal 5,000. In that case, 5,000 divided by the new A gives us what B has to be. OMG token has to actually be 452 because we added a token on this side, so therefore this number has to decrease a bit in order for this number to, or this formula to still be true. So that's why we do 5,000 divided by A to say this is what the B should be. Okay. So because there's more than this amount in the pool currently, the buyer gets the difference, the 500 minus what it needs to be, that 45.3 difference. That's what the buyer gets. So imagine some sort of, or in my head, I kind of imagine like a squidgy little ball where you've prodded it on one side and something else comes out or pops out on the other side. In this case, somebody came into this liquidity pool, poked it on the one side by adding Ethereum, and out came some 445 OMG tokens on the other side. So that's essentially the exchange happening. Now that fee that we talked about, that fee is actually added back to this 5,000 number. So we end up with a new number, which is now 5,001. This is now the new constant. So whilst we said that constant is a constant, you think it never changes, actually this number that we saw on the other page does change. It keeps increasing as transaction fees are added to it. But this is basically the take-home winnings of the person providing the liquidity pool. So the person who at the very beginning said, okay, I'm going to give you 10 Ethereum and 500 OMG tokens, and you, Uniswap, you can now set up a pool on my behalf using this set. And that was had a total value, I shouldn't really call it value, but total invariant number of 5,000. They're getting a new invariant number of 5001 because the transaction fee gets added into here, because ultimately the person providing the liquidity, they're the ones that will get this transaction fee as a reward for providing the liquidity. So this is kind of keeping track of their score. Think of it as a score. It's keeping track of how much their pool is worth with every transaction that takes place. And that relationship between one asset and the other asset is what this chart is showing. It's showing that if the quantity of asset B increases, then asset A has to decrease, and vice versa. And because it's constant, then this is what the shape of that curve looks like. So this represents that score of 5,000 that we talked about. There's some variations on that formula. So Bancor's formula, whereas here we have two different products, A and B. Bancor's formula is an extension of that, but it allows any number of assets. So you can have X times B times C, or three different assets together, and that's what this chart is showing. If you had three different assets, here's what those lines would look like, the same lines that we saw here. Now, one feature about this formula is that the more of one type of asset that you put in, the less of the other type of asset you get back over time. So if this was your liquidity pool and asset A was Ethereum and B was Bancor, and let's say you were somewhere here on the chart and you want to get some Bancor, you want to get asset B. So you're saying, okay, I'm going to put in more Ethereum, asset A. So if you put in more Ethereum, then you're going to go to the right on this chart. That means more Ethereum. And so you ask yourself, well, how much Bancor does that get me? You follow the chart down. So that a drop from up here to here is the excess Bancor that isn't needed by this pool. So that extra Bancor will be given to you. You will get that that drop that you just saw, so that we get back to equilibrium. But let's say we did the same thing all the way up here. This is where there's a lot of Bancor in the system. There's not enough Ethereum. When you add in one extra Ethereum and you follow that drop, you get a lot more Bancor for your Ethereum. That drop here is a lot bigger. So when there's lower amounts of Ethereum, then you're going to get huge amounts of Bancor because there's already a lot in the pool. Whereas the more Ethereum exists in the pool, over here for example, you add in one extra Ethereum, you're going to get a tiny fraction of a Bancor. You're not going to see much of a difference. So that's an important trait of these curves. So concentrated liquidity is an important concept. It took me a little while to get my head around this. Hopefully I've managed it. So I think what they're saying here is this line where it says in unconstrained liquidity, one provided in the full CFMM range of 0 to infinity, capital is highly inefficient. For instance, in Uniswap, the trading pair DAI to USDC assigns only 0.5% of the liquidity for the trading range between 99 cents and $1.01, through which the majority of trading volume goes through. So I think what they're saying here is that formula that we saw above that gives you this curve, that is operating on the basis that somebody might want to trade up here and they might want to trade down here. So it could be, all of these could theoretically be a possibility. So the formula is set up to make sure there's liquidity at all these levels. However, in practice, most people will want to trade within a certain narrow trading range. So it'll go one way, the pool will go one way, then the pool will go the other way. So most of the capital, the liquidity that you've put into that pool probably will never get used according to the formula above. It's actually just sitting there idly. So instead, there's this concept of concentrated liquidity, where essentially you're saying if the price goes to a certain boundary, then there is no transaction that can happen, that your liquidity pool will only operate within certain very narrow price boundaries. And after that, it kind of, sort of drops off a cliff. And that way, you're not having to put in as much liquidity into the pool, and then you can make use of that liquidity that you save somewhere else. So again, going back to the efficient use of capital hypothesis, an efficient market where most of the trading happens around here it doesn't need to have capital sitting around on the edges waiting to, well, essentially never get used. So that's one improvement Maladex hope to make to DEXs, capital efficiency. The other one is impermanent loss, and this is an important concept to understand if you're looking to trade on existing DEXs. What it boils down to is, in a liquidity pool, we talked about how that pool is fixed to a constant, this K value that it has to match, although that K value goes up incrementally with every transaction. But by and large, it's stuck to this K value. That's set at the time that you create the liquidity pool. This is the value of your pool. But either of those assets in your pool, that could actually change in respect to, let's say, the US dollar or whatever national currency you ultimately want to exit into. And the problem occurs when the dollar value of either A or B changes a lot. The pool is still stuck using this constant K, so the number of tokens has to sum up to K, so it's still stuck in that rule, even though the US dollar price of one of the assets has changed a lot. So as a result, when you exit out of the pool and sell back into USD, you might find you've actually lost money as a result, you know, if there's wide swings in prices. And so you may be better off not to provide the liquidity in the first place. And as this table is trying to show, the main challenge is the exponential nature of impermanent loss. For small asset ratio variations, the loss is negligible, but for large shifts, it easily eradicates all the profits from providing liquidity and from governance tokens earned from yield farming. And you may be seeing some sort of solution when you link it back to what we said about concentrated liquidity. If we know that a lot of the trading happens in this narrow range, and we know that there's more sort of large fluctuations in price, that's when the pool is likely to swing in one direction or the other as people try and cash in on it. Then by restricting the range that you can operate your liquidity pool at, you actually have an automatic cutoff valve when it reaches those extremes. So that's kind of like where this argument is heading. They talk a little bit about risk control here, which I'm just going to skip over, but they'll be covering in more depth in section 14. This is probably the most interesting part of the first part of their very long paper. Cardano offers 3 major innovations, making many of the ambitious goals outlined in this paper achievable. So this is the reason Cardano really helps them in their goals. Smart contracts are composed of on-chain validators and off-chain code. On-chain validators provide the same level of assurance as any other blockchain model, but at the same time, Turing-complete off-chain code enables performing complex and resource-consuming computation without any impact on transaction cost. This is revolutionary, as ideas such as programmable swaps and algorithmic automated market maker (AAMM) would not be possible to implement without it. What's more, on-chain validators provide full scope of smart contract security, meaning that despite the off-chain code, the entire protocol is equivalent to being fully executed on-chain, as all security is achieved on-chain. What this is saying is the Cardano model lets you have a secure system using the security of the blockchain, but lets you also do the computation for doing more complicated trades off-chain. So you can have the best of both worlds. And by complex trades, we'll see what they are later on, or complex swaps. But these are types of swaps that traditionally were only available to advanced traders, you know, hedge funds and the likes. But now Maladex is making it so that anybody could do complex swaps if they wish to. EU TXO fragmentation redeemer model, which provides a unique method to enable many concurrent independent actions to take place in parallel across multiple protocols. For instance, given this fragmentation and desire to arbitrage with other DEXs, this can be done simply thanks to EU TXO model and how redeemers work. And so this is where EU TXOs naturally behave as a parallel sort of system where each UTXO is independent of other ones. And this allows them the flexibility to have all these different swap contracts floating around, operating independently and behaving in complex ways without having to rely on other contracts. I think that's what this is saying. That's kind of what I understood from it. Hydra head, fast and isomorphic state channels, allowing for straightforward usage of the same transaction settlement code in the local Hydra head formation. This enables a significant performance improvement without incurring layer 2 software engineering cost. What that means is they can write once in Haskell, and the Hydra head, which is sort of a layer 2 solution to speed things up, that can read the exact same code. You don't have to do any special coding for Hydra. It's using the exact same model as layer 1, hence why it's an isomorphic state channel, but it's doing it on a layer 2, and hence why the processing is a lot faster. And then down here, Maladex's protocol mission and objectives. They want to revolutionize the world of finance by providing the tools that allow everyone to create sound and efficient ways of investing, increasing the efficiency of the cryptocurrency market and accelerating the transition from traditional finance to decentralized finance, and building the foundations of the financial markets of the future. So quite impressive goals there from Maladex. And so market efficiency is a key part of their strategy. The Maladex platform improves market efficiency by allowing users to create a range of products, allowing for the expression of specific market participant sentiments, from swaps to option strategies and sophisticated or automated trading strategies. We'll see more of that later on. This is interesting. Markets that cannot be shorted, so betting against something, are inadvertently inefficient. This is a simple consequence of the fact that a person who believes that asset X is undervalued can buy it and hold it until the price discovery catches on, while the person convinced that the asset is overpriced cannot take a short position. So this metaphor here really helps explain it. If you can only add water to a jug but never take it away, the amount of water will inadvertently only increase. So if you can only long an asset, but you can never short it, then the price of that asset will just increase, even though there are people out there who think it should be shorted, who think it should be, who think it is overvalued. It can be even stipulated that a lot of volatility in the crypto market takes origin in this mechanic. Due to a lack of sufficient access to short instruments, the price tends to go up until it suddenly reverts to the mean, like stretching a rubber band to its limit. So that was an interesting thought. Because apparently it's harder to do shorts than it is to do longs in the crypto market, that it leads to prices going up until suddenly it crashes back down to what is a fair value. Now, I thought you could long and short crypto assets, unless perhaps you can only do it for certain assets, like the big ones like Ethereum and Bitcoin, but you can't actually do it for all assets. So maybe that's what they're saying here, is that because you can't do it for all assets, only a few of them, a lot of these crypto prices are inflated and they don't have that shorting mechanism to bring them back down to earth until there's a wider correction in the marketplace. And then last but not least, having a trading platform with a wide range of tradable crypto assets, indexes, derivatives, mirrored assets. So all these things that advanced traders will be interested in, enable the development of more specialized financial platforms on top of this infrastructure layer. One example of such a layer would be the creation of a distributed hedge fund, allowing users to stake investments in automatic trading strategies and bots, providing exposure to a wide range of additional sources of alpha. So if I've read that correctly, what they're saying is all these advanced methods that were previously the domain of hedge funds, you could automate that, put that into a bot, and get rid of the middleman, the hedge fund manager person, and have that trading strategy accessible to anybody that wants to invest in it. So they are talking about disrupting the hedge fund industry here. That's pretty big. So of all the different DEXEs, a lot of the DEXEs just want to do very simple capabilities, very simple swaps. Maladex are going after the big kahuna here. They want to take all that advanced trading capabilities and move it into the blockchain and disrupt the hedge fund industry. So I'm going to end this video here as it's already quite long. I hope to finish off the video tomorrow, or at least get to another chunk of this very long report. So right now I'm on page 19 of 88. After this, it does get a lot more technical, so I'll see how I do. But hopefully in this part of the video, it's laid the groundwork for understanding key concepts and terminology, as well as understanding what Maladex are hoping to achieve through their DEX. Please give this video a thumbs up if you enjoyed it, and consider subscribing if you already haven't, and I'll talk to you again soon.